Welcome to the deep dive. So you've shared some info with us about these pretty big shifts happening in the energy sector,
Yeah, things are definitely moving.
and you're looking to kind of cut through the noise, figure out what's really going on without getting lost in all the details.
Exactly. Just the core issues.
Okay, let's do it. We're diving into how these new tariffs and, well, that significant drop in oil prices are impacting things, specifically for the U.S. oil field service companies.
Right, the OFS sector, they're really at the intersection of this.
You sent over some news pieces, some industry analysis. Our goal here is just to pull out the key takeaways for you. We'll look at the financial side, the operational challenges, what's happening with supply chains, investment.
And importantly, how these companies might be responding. What strategies are they looking at?
Exactly. So let's jump in.
Okay. It's a really interesting, maybe challenging is the better word, moment for the industry.
Yeah.
What strikes me is how these two big economic forces hit almost at the same time. It's like this pressure cooker effect.
Okay, let's set the scene. We're talking early April 2025.
Pretty the same frame, yeah.
And it feels like a real 1-2 punch, as you said. First, these new tariffs. The Trump administration put them in place.
That's right. A 10% baseline duty on, well, most imports.
Most imports.
Yeah.
And possibly higher for some specific countries?
Yeah, the details mention potentially higher levies, though not specifying which countries exactly in the source material we have.
Got it. So that's a first hit, a broad tariff.
And that immediately adds costs, especially for a sector like energy that relies on a lot of specialized international parts.
Right. And then almost at the same time, oil prices took a nosedive.
A pretty sharp one, too. Brent crude, it fell, 3.79%, down to $60.44 a barrel?
And WTI U.S. West Texas Intermediate dropped even more.
Yeah, 4.13% down, hit $57.12.
And that's significant because
Those were the lowest prices we'd seen for Brent and WTI since way back in February 2021, so a multi-year low.
wow. Okay, so put those two together from the perspective of an oilfield service company.
Right. So suddenly the stuff they need to buy costs more because of tariffs.
Okay.
And at the exact same time, the price their customers, the oil producers get for their product, oil, has dropped significantly.
That's the squeeze. Higher costs, lower potential revenue for their clients.
It's a classic double whammy. Really forces them to rethink, well, everything, their whole strategy.
Which naturally leads us to the big players.
Yeah.
Schlumberger, Halliburton, Baker Hughes. How did the market react?
Oh, the market reacted quickly.
Why?
And not positively for them. Stock prices took a hit.
How big a hit?
Pretty substantial. Schlumberger, their stock went down 12%, ended up around $34.60.
12%. Okay. Halliburton.
Halliburton dropped 10%, landing just over $20 a share. And Baker Hughes saw an 11% decrease. Their stock went down to about $36.40.
Those are really significant drops in a short space of time. It shows you how worried investors got, right?
Absolutely. It's that immediate assessment of risk.
So what were the specific worries? What were investors thinking?
It really comes back to those two main pressures we talked about. First, the tariffs. Investors see those and think, okay, operational costs are going up.
Right. Makes everything more expensive for them.
Exactly. And second, the lower oil prices. That signals potentially less drilling activity down the road.
Because if producers earn less per barrel,
They might pull back on new projects, yeah. They might become more cautious about investing in drilling.
which means less work for the service companies.
Precisely. Lower demand for the services that Schlumberger, Halliburton, Baker Hughes provide, that combination is what spooked the market.
Okay, let's dig into that operational cost side a bit more. You mentioned specialized parts. How exactly do the tariffs make things painful day to day?
Well, think about what these companies use. It's a huge range of equipment, lots of it imported.
Like what specifically?
Things like pipes, obviously crucial for moving oil and gas. Valve fittings, you need those to control flow in the wells. Even, simpler things like sucker rods for certain types of pumps.
So it's not just the really big complex machines.
No, not at all. It's quite granular. It affects a lot of essential components across the board. And companies that built their supply chains using international sources, maybe for cost reasons, or because certain parts are only made well overseas.
They're suddenly more exposed.
Exactly. Their carefully optimized sourcing strategy now has this added tariff cost layer. Makes things tricky.
And we actually have a quote here, right? Ron Gusek, CEO of Liberty Energy.
Yeah, that was a good concrete example.
He mentioned the 25% tariffs on steel imports, which were already in place, I guess.
Right, predating this new, broader tariff.
And he said those were hitting components like perforating guns.
Perforating guns, yeah. Absolutely vital for fracking. Can't really do modern fracking without them.
So that really connects the dots. Abstract tariff policy hits a very specific, necessary piece of equipment.
It does. And Gusek also mentioned what Liberty Energy is doing about it.
Which is?
Passing those costs on. They have to pass the increased cost of those steel components along to their customers.
The exploration and production companies.
Yeah.
The drillers.
Right.
So that just feeds back into the loop, doesn't it? If drilling costs go up for the producers, that reinforces the worry about a slowdown, especially with oil prices already low.
Precisely. It becomes this cycle. Rising input costs for the service companies lead to higher charges for the producers, which, combined with low oil prices, might dampen the producers' willingness to drill. It's a really tough spot for the service sector.
Yeah, definitely a precarious situation. And you said this isn't just about a few big companies feeling the pain. It has wider ripples.
Oh, definitely. Much broader implications for the whole U.S. energy industry.
Okay, let's talk about those ripples.
Yeah.
Beyond direct costs, what about supply chains? You mentioned disruptions.
Right. Tariffs inherently disrupt things. Companies spend years, decades sometimes, building efficient supply chains, finding the right suppliers, negotiating contracts, setting up logistics.
Getting everything just right.
Exactly. Then suddenly, tariffs come along and throw a wrench in the works. Those established routes become more expensive, maybe less reliable.
And the U.S. energy sector uses a lot of imported steel and aluminum, right, for equipment.
A significant amount, yes. So these tariffs hit hard there, leading to higher material costs and potential delays if they have to find new sources or wait longer for deliveries.
It's not just the immediate price increase then.
No, it's also about relationships. Maybe you had a great relationship with a supplier overseas. They knew exactly what you needed. Now that relationship is strained or maybe needs to be replaced. Finding a new supplier, getting them up to speed, ensuring quality, that takes time and money too.
And this isn't happening in a vacuum? There's always the risk of other countries hitting back, isn't there?
Yeah.
Retaliation.
That's a huge concern, yeah. Retaliatory tariffs from trading partners could make things even more complex. Maybe they target U.S. energy exports or add costs in other ways. It just adds another layer of uncertainty.
Okay, so supply chain headaches, potential trade disputes. What about future planning? Investment, growth. How does this combination of higher costs and lower prices affect that?
It forces a major rethink. I mean, if your costs are going up and the price of the end product, oil, is going down, you have to be much more careful with your money.
So capital expenditures, like buying new rigs or equipment.
Exactly. The companies are almost certainly scrutinizing their CapEx budgets very closely. Plans for buying new equipment might get paused. Expansion projects might be delayed.
What about things like share buybacks?
Those could also be on the chopping block. Companies might prefer to hold on to cash in uncertain times rather than spending it buying back stock.
So basically belt-tightening across the board. Less investment in growth.
Potentially, yes. Ambitious expansion plans that looked good when oil was higher might suddenly seem too risky. You might also see shifts in R&D, maybe less focus on long-term innovation if short-term survival is the priority.
The analysis did mention something interesting, though. That some companies are maybe better positioned than others. Specifically those in the Permian Basin with low break-even costs.
Ah, yes, that's a really key point. The Permian is generally known for having lower production costs compared to other regions.
So they can make money even when oil prices are lower.
Exactly. Their break-in point, the oil price they need to cover costs and turn a profit, is lower. So when prices dip like this, they still have some margin to work with. They have more cushion.
Whereas companies operating in more expensive areas.
They feel the pinch much harder. Their profit margins get squeezed much more significantly or might disappear entirely at these price levels.
So it's not uniform pain. Depends on where you are and how efficient you already were.
Very much so. Cost structure and geology play a huge role in who can weather the storm best.
Okay, so it's definitely a challenging environment, lots of headwinds.
Yeah.
What can these companies actually do? What are the strategies for survival, for adaptation?
Well, several key things come to mind, and we're likely seeing companies explore all of them. One big one is diversifying suppliers.
Right, trying not to be reliant on the tariffed sources.
Exactly. That means actively looking for alternative sources for those components, maybe finding suppliers in countries not hit by the tariffs.
Or negotiating harder with existing ones.
Possibly, yeah. trying to see if suppliers will absorb some of the cost, or even looking at bringing manufacturing back home, reshoring.
Is that realistic?
Right.
Reshoring.
It can be complex and expensive, especially for specialized parts. Finding domestic suppliers with the right capabilities and quality control isn't always easy or quick. So diversification is logical, but it has its own hurdles.
Okay, so try to find different suppliers. What else?
Operational efficiency becomes absolutely critical. You have to find ways to do more with less when margins are tight.
How? Like new technology.
That's a big part of it, yeah. Investing in automation, using data analytics better to optimize operations, also streamlining processes, cutting waste, adopting, lean management techniques, anything to squeeze out costs internally.
Makes sense. Try to offset the external cost pressures by being leaner internally. What about the oil price volatility itself? That's a huge risk factor,
Absolutely, and that's where financial hedging comes in. It's a vital tool.
like insurance against price drops.
Sort of, yeah. Companies can use financial instruments, things like futures contracts or options, to lock in a price for some of their future production.
So they know what they'll get, even if the market price falls further.
Right. It provides some revenue certainty, helps stabilize cash flow. The flip side is you might miss out if prices unexpectedly shoot up. But in this environment, predictability is often worth paying for.
Okay, hedging for price risk. And then there's the policy aspect itself, right? Can they influence the tariffs?
Well, they can certainly try. Advocacy and policy engagement are definitely part of the playbook.
How does that work? Lobbying.
Essentially, yes. Companies, often through industry associations, will be talking to policymakers, explaining the impact of these tariffs on their business, on jobs, on the wider economy.
Making their case for maybe exemptions or changes to the policy?
Exactly. Advocating for trade policies that they see as more favorable or at least less damaging to the energy sector. It's about making their voice heard in Washington.
Okay, so let's try and pull this all together. It's a really complex mix, isn't it?
It really is.
You've got U.S. oilfield service companies caught between these new tariffs pushing their costs up and falling oil prices that threaten the demand for their services from producers.
A tough position.
And this is hitting their stock prices, causing operational headaches, messing with supply chains.
Right, and forcing them to really rethink big investments in future growth.
But as you said, it's not just doom and gloom. They are reacting.
Absolutely. They're looking at diversifying where they buy things. They're doubling down on efficiency, using financial tools like hedging.
And talking to policymakers?
And engaging on the policy front, yes.
Mm-hmm.
These are the strategic levers they can pull to try and navigate this. How well they execute will really matter.
Well, this has been incredibly helpful, really unpacking what's going on beneath the headlines. It's clear just how interconnected these economic forces are and the kind of pressure they're putting on this vital sector.
Yeah, it's a dynamic situation.
It really makes you wonder, thinking beyond these immediate tariff and price pressures, what other things are out there? What new technologies or maybe big shifts in global energy demand might really reshape U.S. energy production and procurement even more fundamentally in the coming years?
That's the big question, isn't it? What's the next disruption or the next evolution?
Definitely something to keep thinking about. Thanks for diving deep with us today.